In today's video, we're going to be talking about one of the most important topics of trading, and that's risk management. I'll teach you about what it is, why it's so important, and show you a couple different examples of good versus bad risk management and how that can dramatically impact how much you win or lose over time in trading. Now, just a heads up, this is part 5 of the Technical Analysis 101 series. While you don't necessarily need to know every detail of the first 4 parts before watching this one, I believe that parts 1 and 4 and part 5 here go hand in hand extremely well towards guiding you towards a successful trading career. So if you've not checked out the first 4 videos of this Technical Analysis 101 series, I'd highly recommend you do so after watching this one. So first off, what is risk management? Risk management is basically just controlling how much you win on a trade that goes right and how much you lose on a trade that goes wrong. Now this sounds pretty simple, but it's actually one of the hardest concepts to grasp in trading, and without mastering and understanding risk management, I can almost guarantee you will not be profitable as a trader. In order to have sustained success in trading, you absolutely need to practice proper risk management. So why is risk management so important? It's so important because you're not going to win every single trade you take. Make sure you ingrain that in your mind. You're going to have losing trades. Even the best traders in the world have losing trades. It's absolutely impossible to not lose ever in trading. Now, the fundamental goal behind risk management essentially states that you need to lose less than you win. And this is pretty straightforward if you're just thinking about generally what you want to happen. So let's dive into the charts and look at a couple examples of different risk management strategies. For now, let's just say you win 50% of your trades. Excellent traders tend to win around 60-65% of their trades. However, with a 50% win ratio, it's still very possible to make a lot of money trading. So we're going to use that number for now as a good guideline here. I'm going to pick a point on the chart here, and I'm just going to practice as if I'm entering. Now, maybe through the first 4 parts of this Technical Analysis 101 series, you've developed your own strategy of when to enter into a trade and when to exit, but if not, I'm going to keep it pretty simple for this video. Let's just say we're looking for a series of red candles on an entry here, and once a green one comes, on the next green one after that, we'll enter. So you see this downtrend right here, there's a whole bunch of red candles in a row, we get this small green candle. Both of them have a wick on the bottom, which confirms our entry as well. And then once this green candle starts to come in, maybe near the close of it, we're looking for a long position. We think we're buying the reversal of this huge downtrend once we see these green candles start to come in. Again, this is not a very specific strategy, and you'll have to test it if you want to use it in order to see if it works. I'm just showing you an example for risk management purposes. So I'm going to grab my long position tool just to show you what it would look like. I'm going to enter at the top of this green candle here when it closes, which is basically the open of this next candle. And I'm going to click right there with my long position. And let's say I'm putting my stop loss below these candles down here. So I know as soon as I'm entering the trade, if the price breaks below these 2 wicks down here at 38.70, then I'm going to stop out of this trade. So I'll move this red up just below that. So if we go a couple pennies below, I'm stopping out of this trade. Now, just for the sake of the argument, let's just say our profit-taking strategy is to gain 20 cents on the trade from when we enter. So we entered at about 39.09. Let's say we're looking to take profits at 39.29 on this. I'll move down this green area here to 39.29. So you can see in this situation that entering right here, targeting up here, we would have actually made money on this trade. The trade immediately went up right to our target, and we would have hit our profit target and sold out of the trade. However, let's go back to that 50% ratio that I was talking about as your win rate. Let's say every time you take this trade, you only win half of the time. In other words, half of the time you're going to make that 20 cents that you were targeting, but half of the time you're actually going to lose 41 cents. So to throw a little bit of simple math on it, let's say you have 10 winners, 10 losers. They all look just like this right here. You'd make $2 on the upside from your winners, that 20 cents times 10, and you'd lose $4.10 on the downside from your losers. Now, as you can see, of course, you're losing money over time. Your total losses are higher than your total wins. So this is obviously not going to be profitable to target this small of a win relative to this large of a loss if your win ratio on the trade is only 50%. Let's look at a second potential risk management strategy here. We're going to be entering the same long position here with the same stop loss, but let's actually decide that we don't know when we're going to take profit. We're going to try and let the market continue upwards and upwards, see if we can kind of hit a home run and maybe take profit all the way up here if we were to get there. Something like that. Now this is fine. It brings your risk management, your risk to reward ratio, which is basically just how much reward are you possibly getting versus how much risk are you getting. And we're dividing the green by the red here. So you can see this would be targeting 4.12% and risking 1%. So a risk to reward is 4.12. And this is actually a really good risk to reward ratio. However, now you're probably going to compromise that 50% win rate. So what some beginner traders might do in this situation is once the trade starts to go in profit for them, they actually end up moving their stop loss up to break even. And moving your stop loss up can actually be a really good strategy. However, if it's executed wrong and your profit target is too high, it actually could end up being really detrimental in your account. Let's say that we're going back to our first risk management strategy, and as soon as we're 20 cents in profit, we're actually going to move our stop loss up to break even on the trade. So if it falls back down to where we entered, we'll just exit the trade, we don't lose anything. And then as condition number 2, if we go $1 into profit, we'll actually take profit on the trade. So pulling back down our red here, you can see that our risk to reward ratio is 2.5. Now remember that anything greater than 1.0 on the risk to reward ratio, if your win rate of that ratio is 50%, means you'll make money. If the green is more than the red and happens just an equal amount of time, you're going to have green in the long run. As your win rate decreases, you need this risk to reward ratio to increase to offset that. And you can run these calculations by yourself, but basically with a 1 to 2 risk to reward ratio, where you're winning twice as much as you're losing, you need to win only about 1/3 of the trades. Because if 1/3 of the trades make you $10 and the other 2/3 of the trades lose you $5, that's your break-even point. You can do the math on any risk to reward ratio by doing 1 divided by the risk to reward ratio plus 1, just like this. So if the risk to reward ratio that's showing up is 2, it would be 1 divided by 2 plus 1, which is 3. So 1 divided by 3, or you need to win 1/3 of the trades. If we move our risk to reward ratio back up to 2.5 as we were just targeting, the formula ends up looking about 1 divided by 3.5, which is a little bit under 30% of the trades that you take. Anyways, back to the break-even situation. Let's say every time we run 20 cents in profit, we're moving that stop loss up. You can see this actually helps our risk to reward ratio a ton, of course, because now we have no risk. It's only profit or break even on the trade. The huge problem with doing something like this is that you're going to end up stopping out much more than you're going to be hitting that profit target. So while a majority of your trades might end up break even, most of the other ones are actually going to be at that losing condition. So for example, you might have 70% of your trades break even, but then 25 or even all 30% of the other trades are going to end up being losers just off the bat. You might not be giving the trade enough time by pulling your stop loss up so soon before it can hit that profit target that you set. So that's an introduction to risk management, the most important topic of trading. Yes, I know I've said that a few times already. I want to really engrave it in your head that you need to understand and follow proper risk management. In order to figure out what risk to reward you need to be targeting, I would highly recommend that you figure out what percent of the trades you're actually winning. If you're winning 50% of your trades, target a risk to reward ratio that's a little bit greater than 1. So each time you win, it's more than when you lose. If you're only winning, say, 40 or 30% of your trades, you're going to need to target a lot more on those winning trades. These two variables, your risk to reward and your win probability, over time will tell you just how profitable you'll be as a trader and whether or not you need to modify your strategy at all or it'll work going forwards. So I hope that helps you all on your journey towards being a profitable trader. If you liked this video and want to see more similar content, please click the like button below and hit subscribe for future similar content. And lastly, if you have any suggestions for what you want to see in the next video of this Technical Analysis 101 series, or the next video in general, please let me know in the comments below. I love listening to, responding, and acting on all feedback from everyone. And as always, good luck trading.